What is up, YouTube? This is the Working Investor. This video, we're going to look into YGLD from Simplify. The reason why we're going to this video is because I had an excellent comment from one of my subscribers. Thank you, the Hoop Scoop. I really appreciate your comment about my previous video, and it was mentioned about YGLD. Nothing here is any type of advice, whether financial, tax, legal, or anything else, and please use your own risk. Consumer discretion is advised. So the first question is, why? Why this fund? The reason why I have a use case for this fund, in my opinion, is because it gives you some diversification. The market was down. You could see the S&P 500 was down 2.66% year to date, while GLD is up 19.7%. So that's a very nice way to kind of damper that fall by having this inside one's portfolio. GLD is 15.75%. But we'll learn soon that YGLD does have a leverage component on futures, hint, hint, hint. Hence, it may have a higher return. SHNY is something I mentioned in my previous video, which is a triple leverage ETN on gold. And hence, I'm not surprised that it has about triple the return of GLD, but it can also have triple the risk. So just be advised. XDTE down 1.79%. Of course, a little bit better than the S&P 500 because they have some premium, 0-day to expiration with overnight exposure, with massive theta decay, which is helping getting some more higher returns. And YMAX is down 5.67%. But you could see having some of these gold in your account could help at certain periods of time to buffer out the downturn. And if you go onto Portfolio Visualizer, if you look at something called correlation coefficient, it tells you how strongly an asset is correlated or uncorrelated. 1 is perfectly correlated, so it's not really giving you a hedge. And 0 is uncorrelated, and -1 is like extremely uncorrelated, like a pure reverse of the underlying. So you can see here GLD versus US market is about 0.03 or 0.1. We saw in a different video that compared to the S&P and the NASDAQ, I kind of broke it down and it was like 0.12 or 0.1. Basically what you see over here, it's very, 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 it's not correlated, maybe slightly. And of course, correlation could be dynamic. Some periods of time, it tends to be more correlated, some periods of time not. So that's a disclaimer. So let's talk about what it is, right? So basically what they're doing is they're using futures and they're trying to give you 150% exposure to gold via vehicle of futures. But that means you have about 1.5x leverage built into the fund. So if someone's using margin and using this, just bear in mind, if you're using double all your margin, now you're technically 2x leverage, and then with 150, times 1.5x, so you're like 3x leverage if you're using margins. Just be careful when you're using margin and stacking up other things that are, pretty much multiple time leverage, So they also do this unique thing called option overlay with put credit spreads. I don't know if I like it or don't like it. They basically do put credit spreads on a bunch of commodities, including, the commodity of gold, but also equities is what I mean to say. So you just press on holdings over here. You'll see here they're doing some put credit spreads on gold. Gold is trading around $280, $281 per share. I'm sorry, GLD is trading there. And you can see over here their highest short put is $270. So they're about $11 out of the money. And I like the way they stagger it, though. They kind of mix up they do different strike prices of spreads, and they do different expiration dates. So they kind of give you a little bit of a mix. You could see here, like out of nowhere, they kind of pull out a hat MSTR, single stock. You got single stock risk now, and it's on Bitcoin, which is a wild card, and it's trading somewhere I think in the 230s. I'm sorry, 320s is trading. And you could see that their highest short put is 280. And then you have the three indices, NDX, which is the NASDAQ. And then if you go down, you could see they have the RUT, which is the Russell 2000. And then, which is small cap blend. And then SPX, which is large cap blend, AKA S&P 500. And so you see they're doing the three major indices. They're doing a single stock wild card. And then they're doing some put credits. All these are put credit spreads, and in addition to GLD, right? For those yield chasers out there, it's very, very anticlimactic because if you go to distributions, they've been out, I think since December of last year. So they've been out but they've been out this entire quarter. So they gave a whopping 15 cents of dividends, and you'll see that their next dividend distribution is, in June. So it looks like it's quarterly. For us spoiled brats here, we like to have weekly. I know some people are talking about they want to have daily dividends or hourly dividends. I don't know. Some people really want dividends maybe every minute. But the old-fashioned, way of dividends used to always be quarterly. But this could be, in this environment with so much competition, it could be I could see a lot of people not going after this. Looking at the yield, it's not that enticing. It's only a 2.15% yield if you analyze it. And of course, who knows, maybe some of Simplify's products kind of vary, so it's hard to extrapolate. I've seen them sometimes do 15 cents, and then at the end of the year, they kind of pull out like $1 or something. So we have to give it some time to give you the actual absolute yield. But so far, the start doesn't seem very, very enticing. So it's kind of like a little extra bonus, but it's not the main reason to go into this income fund. So the question is, do I like this fund? So there's some pros and cons. The pros are, of course, I like the 150% exposure to gold if you like some leverage. But then what may or may not be good is the put credit spreads, especially the put credit spreads on the equities. Because when somebody goes in my mind, the way I look at this, if I'm going into gold, I'm looking into a precious metal commodity. I want something that's uncorrelated to the market. Even if it underperforms a little bit to the S&P 500, I'll take that because it's going to give me a buffer. It's going to give me a little bit of a buffer and a hedge against having something that's not super correlated. But once you start mixing in correlated assets, you're literally mixing in the S&P 500 put credit spreads, the Nasdaq. I know that you're not participating 1-to-1, but you do have that risk. So when the S&P, Nasdaq, Russell goes down sharply, you're going to lose. Whether they close the spread or they take the loss or they roll it, there's going to be definitely some potential of risk on the downside. And, even though the gold component of the upside could go good, because if gold goes up when the S&P goes down, it doesn't necessarily work that way, but it could. I could see the GLD spreads not getting challenged, but the other ones could get challenged. So I don't know if I like how they mix it in there in itself. You know what I mean? It depends how you want to take it and how you want to mix and match it and pair it with your underlyings. Again, this is just my personal, take on it. No advice whatsoever, financial, tax, legal, or whatnot. Anyways, I hope you guys enjoy. This is The Working Investor over and out. Let me know what you guys think about this fund or any other funds that are uncorrelated to the market with good returns and income.